tips there. But Todd is going to give us a great update on the market. I've heard his talking points, and obviously he and I have been talking all day long every day about what's going on with the market. And before I turn it over to him, I just wanted to make a few comments about what's going on in all of our worlds right now. I believe some of the comments apply to all of us, but that I'm about to make, but I'm going to put it in the context of me. So my number one priority every day during this crisis is to stay focused on those things that I can control. And two of those things that I can control that are the most important are my attitude and the actions that I take. I will not, and I cannot afford to allow fear to enter the equation. There's a very big difference between all of us digesting news and research and making appropriate, unemotional decisions. There's a big difference between that and being gripped by fear. And so I think all of those points apply to all of us, not just us here at Gratus. And so there's just, a quick reminder, things that I cannot control. I cannot control any aspect of this virus other than staying clean, keeping my hands washed, and staying home. I cannot control how the government responds to it, and I certainly cannot control how the markets respond to it. But the things that I can control, my leadership of this team at Gratus Capital, the effort that we put into communicating with you. I can control the effort we put into protecting you and protecting the decisions that we make with the portfolios. And most important, I can control not letting fear impact my decisions or my behavior with leading this team or with leading our client base. And I think, again, a lot of that applies to all of us. But let me tell you what I see going on at Gratus right now. We are pulling together as a team like I've never seen us before, even though we're working remotely. We are working as hard as we've ever worked right now. I'm seeing an attitude of teamwork, empathy for our clients and what they're going through, and proactive actions being taken by our investment team, our advisors, and so forth, so that we come out of this situation better than we went into it. And those things do excite me every day, even with dealing with all the negativity that's going on in the world right now. So a few things for us to consider. Can the market go lower from where it is right now? Yes, it absolutely can. And more than likely after the rally we're having today, it probably will. Is it possible that one of the companies in our dividend strategy may cut or suspend their dividend for some time period? Yes, that is possible. Is it possible that one of the private investments in our private income generating funds, is it possible that one of them suspends their distributions for a quarter or two? We've gotten no word that that may happen, but it is definitely possible. But I think these are things that we're factoring into all the decisions that we're making. These are things that we're factoring into the communications that we're having with you, with having straight talk and being direct with you about what we're seeing and the actions that we're taking with the portfolios. And all of these things are possible, but I strongly believe any of these actions will be temporary. And Todd's going to point out some things to you as to why we feel that way in a few minutes. But I remember after 9/11, when we went into a deep recession, and he's going to show you some charts from 9/11 and 2008 that look very similar to what we're dealing with now. But I remember when we went into that deep recession, and many people on CNBC and economists said that it would be a very long time before we recovered, and some aspects of the economy would never recover. They said that we would never fly again like we were pre-9/11. I remember in 2008, March of 2009, when the Dow hit 6,600. And more than half, probably 75% of the quote experts on CNBC were saying that the market was going to 4,000, maybe even 2,000. Many articles came out at that time saying that municipalities would never be able to make their obligations with interest payments and principal payments. So remember that the media makes money off of spreading doom and gloom. And I am not saying in any way, shape, or form that we're not in a bad situation. I'm not saying that this virus is a new situation that we haven't dealt with before. But you're going to see more articles now than you've ever seen about why the world is not going to survive this and all the negativity that's going to come from it. And the market will not feel good when it starts to return, because Todd is going to point out to you in a few minutes that the market is always discounting 6 to 12 months in advance. The market has already assumed that we are in a deep recession. The market is already assuming that unemployment is going to skyrocket. That is baked into the numbers right now. So I'm not painting a rosy picture of being an eternal optimist. I'm telling that the market is already factoring these things into the pricing as of today, and it can go lower. But Todd is going to show you some things on his charts where we're already seeing some areas of improvement. So the actions that we're taking every day right now here, we are talking to the managers of the mutual funds that we utilize in our portfolios, making sure that all the investments are sound in those individual funds. Our investment team is constantly analyzing and making some changes in our dividend strategy, our stock portfolio, to make sure that we're owning companies that we feel are going to be best positioned when this thing does turn. We are looking at evaluating our rebalancing targets. So if a client has a 50% in equities and now they're sitting at 46%, we've already rebalanced once, we may rebalance again. Why are we doing that? Because when the market turns, we want your portfolios to be prepared to get the most out of it. These are proactive measures that you take when you're not emotionally bound to your decisions. Our advisors are on the phone with you all the time, every day, addressing concerns about the market, addressing concerns about your financial plans, and just checking in on you to make sure that you're doing okay. I will tell you that we are 100% committed to you and will not let up. And we will ensure that we get through this thing together, but we are also available. So please, if you need to speak with anyone on our team, go through our advisors to make that contact. I'm available to talk with clients. I've been doing it every day, all day long. Todd, our director of investments, is available to talk to clients. Our entire team is available to you. And again, as I said before, we are working harder than we've ever worked before, and we're not going to let up until we get on the other side of this and everybody is in a little bit of a calmer place. But with that, I'm going to turn it over to Todd now to show you why I have some hope and why I'm feeling better about this situation than maybe many of you are.
Great. Thanks for the intro, Hank. And for those of you that I haven't had the chance of meeting yet, I certainly am happy to do so over this forum. Hopefully you guys can hear me and see what's on the screen. I think, as Hank alluded to, we're going to show you some good information as to why we can't get too negative about what's going on right now. So Hank went through some introductory remarks. I would just say that we do keep all of our clients and our employees' safety top of mind. And these are some of the resources that we've been using. Center for Disease Control, certainly a great place for reference. Georgia Department of Health, amongst others. And I would direct you to those if you had any questions about what's going on and steps that businesses are taking. By way of an agenda, this is the tentative agenda I have today. So I did want to thank you all in advance for those of you that were able to submit questions. I tried to weave in a lot of your questions into this content today. So what I was going to do is go through the COVID-19, which is the coronavirus fact pattern, because I do think that's helpful in framing the discussion. We'll go into the year-to-date performance trends, which certainly have not been very positive, but we'll tell you what we're thinking about those. Also, how we're currently positioned within client portfolios, and then also maybe taking a little bit longer-term view as to the opportunities that are in front of us and how we can benefit from some of the market dynamics we're seeing. So with that, let's get into the COVID-19 fact pattern, because I do think there are some important tidbits to take away. You know, first, of course, I'm not an epidemiologist, and I don't want to pretend to be one, but, you know, I've listened to quite a bit of webcasts on the topic, read a lot of different white papers on this, and there are a few things that I think should be a little bit comforting in all this. Now, currently, you know, what was once located primarily in China is now spread to the epicenter being Europe. You can see, if you can see my mouse pointer, you know, some of the countries now that are showing an explosive pattern in new infection rates. Switzerland, Spain, Norway, Denmark, Finland, with the US not too far behind. This was as of March 18th. So there's been a few days since this was published. But I did want to point out, while yes, the Chinese growth trajectory, the Italian growth trajectory are pretty dramatic, there are a couple of standouts from a containment standpoint that I think we should all be aware of. Those are South Korea and Japan. And you can see them here, I've highlighted on the far right. And while South Korea and Japan have been exposed to the virus fairly similarly number of days to both European countries and the US, their number of infections is really plateaued. And I think that has almost everything to do with the aggressive testing that we think needs to occur to really identify who's infected, who's at risk, and how to isolate those people that are. And so I think taking the example of both South Korea and Japan, where they have things like drive-through testing, 24-hour turnaround on test results, those are some of the decisions, some of the factors that we think are being kicked around right now within the US response, and also now in other parts of Europe that are starting to take this a bit more seriously than at the beginning of March. So that's actually, I think, a positive dynamic. The next piece is that this shows you the number of US tests. So, I think the market about a week ago or 2 weeks ago was discounting the fact that there wasn't a big effort being put on identifying who in the US was at risk or currently infected. And I think you can see here, so starting on March 11th, the testing effort really ramped up from about 2,000 a day on March 11th all the way now to on March 22nd, it was 44,000 and growing after that. And again, the key is if you can identify the problem, then you can fix it. And that's, I think, been the key, is that a lot of people in the US didn't necessarily agree with the assessment of the risk because we just didn't know who was infected and who wasn't. Now it's starting to become a better known item. And I think that goes a long way to making this a more containable outbreak or pandemic. So moving to the next piece here, I have seen some people try to compare this, or heard some clients try to compare this to the Spanish flu. And, certainly they are of the same type of disease, where it's a flu or airborne influenza. But, the Spanish flu is really a poor analogy. And there was a great piece of work done on this by JP Morgan to say, well, there's some big differences between now. So just for reference, reason why people moved to the Spanish flu is that it was very highly infectious, very easily communicable, and the death toll, most importantly, was very high. Now, was it high because the virus was really that bad, or was it high because it caused lots of complications? And I think that is the net of what I think this white paper meant to address. And I think if you read the findings from that time, what you find is that most people didn't die from the primary effects of the Spanish flu. It was really this orange box here. It's the secondary bacterial infections that caused most of the deaths, 80% of the deaths during 1918 to 1920. Because the death toll was pretty massive, and it's scary if people try to relate that to today. The death toll of the Spanish flu was somewhere in the neighborhood of 20%, which meant that roughly at the time, 50 million people globally died from this disease. And that is a scary number. Here, we're nowhere close to that. Scientists estimate somewhere between 1% to 2% death rate. So orders of magnitude different. But the primary reason it's different is for two reasons. Number one, and the findings was that there was no vaccine development at the time. Other efforts were to winding down World War I. The second reason is because antibiotics weren't even available in 1918. I believe the first one was discovered in 1929 and only widely available to everybody else in the 1940s. So that is very different from today, where we have wide availability of antibiotics, as well as a very rigorous vaccine effort going on right now. I mean, I think right now Gilead has the lead drug in vaccine development right now, and it's already in clinical testing phase. So that brings hope that this isn't going to last forever and ravage the global economy, like the Spanish flu. The next piece I wanted to touch on is that, while China's response was aggressive, you can see that if you do take aggressive measures, this shows you, when it started on January 19th, 4 weeks later, roughly, the virus peaked and has gotten under some sort of containment because they took those aggressive measures. And I think now that many other, municipalities, states, countries are starting to take these aggressive measures, that's a really important step in getting containment of this disease under control, which I think will be really well received by the market when it happens. The next piece I did want to touch on was, now that we understand the containment piece of it, what's the estimated economic damage look like? Because, that once we get a kind of an idea of what that might look like, then we can start handicapping in real-time data how we should be thinking about this. So I would say these are all estimates. So there's been no real-time data that have come out about GDP estimates, not even preliminary GDP estimates from either China or Europe or the US. But this was done by the IMF and the World Bank. And their estimates are, at least initial estimates are, this dashed red line here on the far right. You can see various other time periods and how severe things were back then, from the dot-com crash to the subprime crisis. They're estimating that is going to be about a 1% to 1.5% hit to GDP. Now, I personally think that we'll probably get closer to zero globally. But, the good news is that my thinking is probably in line with what most other investment professionals are thinking as well. So that thinking is in the line of, is in the market pricing, I think, for the most part. So that's the estimated economic impact is what we're thinking. Looking at the US, this is, now Goldman Sachs has done a pretty thorough analysis of this. The chart on the screen in front of you right now shows US gross domestic product done by quarter, but it's annualized. This was their initial assessment, I think a few weeks ago. The dark green line is their updated assessment, and what you can see is a pretty nasty picture, where they see the first quarter in the US economy declining by about 6%. You've also got Q2 on an annualized basis, so 1.5 percentage points. Q2, which is really where the brunt of the impact is going to be, is showing a decline in the US economy of around 25%. And that's a big, scary number. But of course, they forecast shortly thereafter a pretty rapid snapback in the plus 10% to plus 8% thereafter until we reach trend growth rate of about between 3 to 4%. So this is a much more in-depth view of the contribution of where those effects are coming from. But I think more importantly, again, if Goldman Sachs has this as their estimate, JP Morgan's got a similar estimate, as does Morgan Stanley and others that I've looked at. If they're all thinking that this is going to be the case or the outcome, then you can feel pretty good that much of this decline is already priced into stocks. And I think that's a key message and a takeaway from today. So now let's go into some of the year-to-date performance. And I did want to make a few notes before we did that. First was that COVID-19, the coronavirus, does represent an existential economic shock that no one could have anticipated. The fact that you're shutting down large parts of your industrial and service economy to get rid of the virus is unprecedented, and it is somewhat putting us into uncharted territory, but it doesn't mean that we don't have a game plan for how to approach this. The second is that the impact of the economy will be severe over the next 3 to 6 months. But again, as I mentioned in my other comments, the markets may have discounted much of this hit already. Other items that I think seeing through to the other side of this to help in the meantime would be that the global central banks are all responding very aggressively right now with monetary policy because they are convinced that they are not going to be having any liquidity problems like we had in the financial crisis. But also global governments are now starting to respond with aggressive fiscal policy proposals. Now, not a lot has been passed yet. We've got one working its way through the Senate right now. And I'll talk about that in just a moment. So let's look at the year-to-date performance for equities. And this has been obviously a pretty ugly picture. So the time frame is from December 31st to March 20th, so last Friday. When I put this together, if you were to fast forward it through today, yesterday was a down day for equities, but today is obviously a very positive day. So maybe a little more positive than what's showing here. But you can see the S&P is in the red line, down about 28, 29%. The Russell 2000, which is the small cap index, is down close to 40. The green line is the MSCI EFA index, which is the all developed markets outside of the US. And then finally, the emerging markets index, which is in the pink line, all coalescing around this down 29 to 30, in the case of small cap, 39%. And just for context of this particular move, I mean, we all know, you've probably read some stories, but I thought this chart did a good job of pulling in not only recent examples, but the Great Depression as well, because that certainly will have some reference point throughout this whole discussion, given the number of dynamics at work right now. But you can see what it's showing you is that days from the peak of the market to the experience thereafter, this is only 25% or greater declines in the S&P. And you can see, you know, the blue line was the Depression, the 87 crash was in gray, the 07 crash was in purple, and the black line is 2000. And of what you notice, of course, is that today the red line has been the sharpest decline, down to 25% or greater in the historical context. And now I'm not reading too much into the rapidness of the decline. I mean, it just makes sense that there might be a faster reaction potentially because of electronic trading now, algorithmic trading, leveraged players like hedge funds that exist more now than they ever have at any point in history. So the speed of which isn't necessarily concerning me necessarily. It's more the absolute drop in numbers. And I think in the slides that are likely to follow, you'll see why we've got some pretty good outlook on where we are from current levels. Looking at the fixed income market, that's obviously something that is important for us because a lot of our clients depend on fixed income, not only for capital preservation, but also for income generation. And if you've been at any of our webinar or our client events, you know that my mantra up to this point for at least the last 3 years has been capital preservation and modest income generation. And I think where we've had most of our allocations would be in line with the aggregate bond index. So most of the active mutual funds that we use would benchmark to the red line here. And this is the aggregate bond index. It's roughly 85% comprised of US government and government-backed securities like Fannie and Freddie. You can see that's down about 2% for the year. The investment grade index, however, has taken a big hit recently because in anticipation of recessions, which clearly we're going to be getting one in the next 2 quarters, bond yields or bond spreads tend to widen in advance of a recession. And what do I mean by widen? Well, investment grade bonds usually give a higher yield than a treasury bond. That difference in yield is called a spread. And the spreads tend to get larger as we get closer to a recession because, if there's a default looming on the horizon or if investors fear there's going to be defaults in the future, they're going to be paying less for that bond today. So that's why all bonds that are credit bonds that are not backed by the government are priced at a spread. You can see the performance of that investment grade bond is down roughly 16%. That's pretty abnormal. You can see the experience of the non-investment grade bond universe, the quote unquote junk bonds here in green, down over 20%. And then of course the emerging market dollar denominated bonds down roughly 20% as well. And so those are really rapid moves, but it does make sense if the market believes there's a recession coming, because there are going to be some winners, some losers, and there will be some defaults. The good news for us, of course, is that we don't have any exposure, as I'll touch on in a moment, to either the green line or the pink line, with only a little bit of exposure to the blue line. And this is another way to look at that spread dynamic, because I know that can be a little bit esoteric. So this is in relation to the blue line I just showed you, investment grade bonds. And you can see going back to 1994, the spread or the amount over treasuries that the bonds have had over time. So currently where we are right now, the way to read this chart is to say on March 18th, spreads have been lower 97% of the time in the investment grade universe. That's a pretty good starting point if you want to be looking at adding to investment grade bonds. Same with junk bonds. But look at where we got to in the financial crisis. And this is not going to be similar to the financial crisis in that the financial crisis incorporated not only systemic banking sector catastrophe, but also a decline in the property market as well as a decline in the overall economy. In this case, we're not likely to have a banking crisis. I'll show you why in just a moment. But we are likely to have some economic recession. So only one of those two is why I think spreads in these bonds haven't gotten as high. The monetary policy response has been fast and furious. This is what the Fed, the ECB, Federal Reserve, ECB, European Central Bank, Bank of Japan, and others have been basically pulling all-nighters, pulling out all the stops, determined to prevent any sort of liquidity crisis or banking crisis. And I'm not going to go through each of these. This is more, if you wanted to take a look at these after the presentation, you're more than happy to. We all know that the Fed has cut rates twice in the last 3 weeks. They've also spun up some asset purchase programs, but the ones I wanted to focus on here, which are a bit more unique from the financial crisis, would be two in red for the US. One is the commercial paper funding facility. This was a lesson learned from the financial crisis that people start to get really afraid if you let your money markets vacillate in value. And by starting up not only this money market liquidity facility, but also the commercial paper facility, the Fed is basically backstopping all the investments that go into money markets right now. So we feel pretty good about money markets being able to preserve their $1 value. Because remember, in the financial crisis, there was a money market that broke the buck, and that caused a bit of catastrophe. That's not likely to happen this time, so that's positive. The second thing, and this is very unique and innovative, I think, in that they created this facility called the Secondary Market Corporate Credit Facility. Now, I'm not saying this is right or wrong, but I'm just saying, identifying it for what it is. And basically what this allows, they announced this yesterday, by the way. What this is that allows the Fed, because there's so many debt instruments now that are owned by exchange traded funds, there can be a liquidity mismatch within exchange traded funds. So this facility right here allows the Fed now to go ahead and buy fixed income ETFs as long as they fit certain criteria. So this is the first time that the Fed is now actively involved in capital markets on the exchange side, where they have the ability to support markets in a different way than the last go around. Additionally, another kind of unique solution that's that has been approved recently has been, not only did the ECB loosen capital requirements, they've also got their own bond buying program. But more recently, Germany specifically, and I would estimate that most other European countries would follow, directed their state-owned bank to support or lend up to 610 billion euros to small businesses directly, zero interest loans for something like, I think it's like 2 to 3 years, so that they can keep people employed, number one, but also to give them enough time to work through what's likely to be a pretty nasty next couple of quarters. So those are really unique, solutions to the current problem, which I think will go a long way to helping bring stability to the markets. In the fiscal policy, I just put a big pile of money on the page because who knows exactly what this is going to look like, but we know two things: that it's going to be massive and it's going to be pretty meaningful. And if you just look at what's being kicked around right now in the Senate bill, it was actually declined yesterday by the Senate Democrats because it wasn't big enough. They had other priorities they wanted to make sure they addressed at the time. So we're looking at somewhere between a $2 trillion to $2.5 trillion relief package. And I think that's going to go a long way to supporting small business, number one, but also part of that provision is to give cash directly to to anyone 18 or older in the orders of somewhere like $2,000 now, and then $1,000 a month for every month that this crisis is ongoing. Now, I know there are some questions and some concerns that clients have around, what's that going to do to our national debt? Well, clearly it's going to really increase the national debt. I mean, so debt to GDP is likely going to go from currently around 7% debt to GDP to somewhere in the neighborhood of 20. And now we should all think about this in terms of being a temporary thing. Hopefully it is a temporary solution to a very bad problem. And we'll be watching obviously to see if this gets taken away eventually. But it is going to make the national debt quite a bit larger. The key question is it going to make us uncreditworthy? I think that's not going to be the case. Is it going to create chaos in our bond markets? I don't think that's likely going to be the case right now. But what we do have to be aware of or concerned with potentially down the road, as I mentioned in my last market outlook, is if you're giving cash to people through debt funding, then you have to be on the watch for inflation. So inflation is a real bad dynamic for capital markets because it means you pay less today in asset prices than you would in the future because they're of the effect of inflation. So we'll be watching for that really carefully. But as for right now, it looks like deflation is more likely than inflation. And so from there, we're just going to keep an eye and see what happens. This is the slide that I think really speaks to the client questions about, because I have had questions about this, is this going to cause a banking crisis? So Bridgewater Associates, the very large hedge fund that's run by Ray Dalio out of Connecticut, they put this estimate together. They put out really good work in the ability that you can get your hands on it. But they estimate that we're not even close to getting anywhere close to a banking crisis. And primarily there's two reasons. One is that through Basel III and Dodd-Frank from the last great financial crisis, you can see that banks' capital, so this little chart is what's showing you bank capital in aggregate in the system. And it's showing you that bank capital has increased dramatically across the whole banking sector. And that provides a level of cushion that didn't exist previously. That's really, I think, gives us a lot of comfort that we're not heading into a banking crisis. But you can see here is that they're estimating losses relating to bad loans or whatever that come out of this particular downturn or relating to Corona. You can see it still doesn't get anywhere close to the minimum capital required to start to cause banks to have to raise capital. Causing banks to raise capital in the middle of a crisis is what perpetuates a crisis, and it does appear that based on this analysis, we've got a long way to go still. So hopefully that answers that question that one client threw out there. And I know the question that's on a lot of people's mind is, well, how much lower can markets go? And while we are not holding ourselves out there as being able to do any sort of market timing, I think, because valuation is actually a poor timing metric, there are some other indicators you can look at that would tell you, primarily from a sentiment standpoint, because humans are still the primary investors within the capital markets, they can tell you, how much anxiety is priced into securities right now. And so what you can see here, this is a chart, and I mentioned this in one of our market updates a few weeks ago, where the VIX, which is the volatility index measures the amount of put buying done underneath of the S&P 500. Put buying is an insurance contract, essentially, that protects you from downside risk. The more this index goes up, the more people are basically hedging their risks. And I think what you might notice, and this goes all the way back to 1991, what you might notice from this chart is that people do the most hedging at the exact opposite or the exact worst time, because you're paying a lot for protection way up here, whereas you'd be paying a very small amount for protection down here. And really, I think the point this chart shows is that we're now at March of 2009, or I'm sorry, Lehman, September of 08 levels on the VIX, some of the highest levels ever seen on the VIX. We experienced last week. We're already coming off that. And the way to read this chart is that if the VIX is going up, anxiety is going up, the market is going down. If this line is going down, anxiety is coming out of the market and the market is going up. So what's already starting to happen right now, we've gone from mid 80s on the VIX down to the mid 60s. As of yesterday when I printed this off, and today this VIX number is even lower now. It's probably down here in the 50s, which, not coincidentally is why we probably have a big move in the markets today. It's just telling you anxiety is coming out of the market. Looking at other buy signals, you can see another one of my favorites is the CNN Fear Greed Indicator. This is a indicator that not only incorporates the VIX, but also incorporates other market measures, things like the ratio of put buying to call buying, percent of stocks trading above their 50-day moving average, percentage of stocks reaching new highs versus new lows, things of that nature. And really what this chart is showing you here, this goes back to 2017, is that we're now at levels of the Fear Greed Index, aka extreme fear, that we saw when the market was down in Q4 of 18. So, I think as you'll see in subsequent slides, now is probably a time to start buying, not the time, but a time. And then finally, this is my favorite because insiders are usually not very willing to step into the capital markets with their own capital and buy stock in their own companies because they get a lot of options that are given to them, and they usually sell as many options as they receive in for compensation on the next grant round. So this is a ratio of buyers to sellers of insiders buying their own stock. A ratio above 1 means there's more accumulators of their stock than there are sellers. And you can see, and this is what I was talking about, the average insider is definitely a net seller. They sell $1 more than they get 50 cents they keep. So what this is telling you is that they are net accumulators now, which hasn't happened very often over the last 20 years. So when insiders are getting bullish about their stock, that lets me think that we're starting to get to levels in stocks, at least on individual stocks, that are making a lot of sense right now. So now we've talked about the coronavirus, its likely implications on the economy, potentially some of the market experience. Let's talk about how we're currently positioned. And I would say we actually came into this crisis at a pretty good in a pretty good way, because as you know that have been to our market outlook events, we've been preaching de-risking across portfolios, whether that was raising cash, whether that was doing things like converting highly appreciated stock to opportunity zones, whether that means setting aside living expenses in cash to just have it on the side, or hedging concentrated stock positions. We came into this crisis in a pretty good way. So that gave us capital. We had been raising cash up and through February over the course of the last 12 months. And what we've been doing recently, we've been doing things like rebalancing. So March 13th, we rebalanced between March 12th and 13th, we started rebalancing all of our accounts. And I think, there's no perfect time to know when this should occur, but we felt that the market at the time was down about 25 or 26%. Based on a more uncertain future, we thought that was a pretty good reference point around which to rebalance. We're also doing things like adding to dividend stocks, either in the index form or in our proprietary strategies that have durable cash flows and solid balance sheets. I know a lot of you are concerned that some of the companies we own might have the potential to cut dividends or suspend dividends. As Hank mentioned, dividends are a discretionary payment, no question, but they tend to be pretty sacrosanct by company management teams, primarily because either they're large stockholders themselves or those companies have built up a following over the years because of that predictable income stream. So companies are very hesitant to cut dividends. We're also doing things like continuing to avoid asset categories that are vulnerable until they get really cheap. And I would say, things like high yield or other parts of the municipal market are starting to get a little silly on the cheap side. And then finally, holding short-term liquidity needs in cash, I think definitely makes a lot of sense for clients that are having some anxiety about what the market is doing, but also giving you that predictability that your cash is going to be there when you need it. And I know working with financial planners, our financial planners, a lot of folks have been making those preparations up to this point. So we feel pretty good about how we're positioned. I would say from a portfolio notes standpoint, we do just some attributes of our portfolio. So we still have, by and large, a U.S. overweight. There are some strategies where we have more of an equal weight, but an overweight to the U.S. by and large, which on a relative basis, if you refer back to that year-to-date chart of the S&P versus other equity indexes, it's held up the best. Similarly, we still like large companies versus small companies. In our market outlook in February, I was mentioning it's access to capital, which really is driving that decision. And I think that's really coming through in spades right now, where large companies have a much easier time getting funding than small companies. And we still think that dynamic will persist. So we're likely not to have a very heavy weighting to small cap unless they get really, really cheap. On the fixed income side, certainly I mentioned we had some exposure to investment grade bond universe that, certainly has been impacted somewhat. But I would say based on some of the price performance of the investment grade universe and municipals, you're starting to see some really weird opportunities in a good way, meaning that they shouldn't really exist. So for example, a AAA municipal bond that's double tax exempt on a 5-year bond, or let's just say a 10-year bond, 10-year treasury is at 80 basis points, and that's a AA credit. AAA muni bonds, which there are plenty of those. You can find AAA muni bonds right now yielding above 3 to 4% on 10-year bonds. So massive differences in yield right now. And we think that's certainly an opportunity that we'll be taking advantage of and have been taking advantage of over the last few days and weeks. And then finally, as I'll show you in a few slides, their liquidity issues are driving new opportunities across areas that we haven't had a big exposure to up until recently. So things like master limited partnerships, which are the pipeline companies, tend to have very heavy dividends, are really interesting right now. High yield bonds now are starting to get interesting again because spreads are widening out to financial crisis levels, which give us a good starting yield. And even things like biotech, which we've been wanting to add as an alternative position potentially, is really starting to get interesting. And I'll show you what I mean here. But if you take nothing away from this presentation, I do want to mention, this is probably the most prevalent question I've gotten from clients is why not sell now and just wait for things to get better? Let me just spend some time on this real quick. Now, the time frame is irrelevant. I'll just tell you that right now. This was the longest time frame I could get on such short notice. This is from 95 to 2014. But I think this gives you a variety of different scenarios where if you stayed fully invested from January 3rd of 95 to 2014, this was your average annual return, so 9.85. If you miss the 10 best days of that, so roughly 7,000 days between 95 and 2014, if you miss just 10 of the best days over those 7,000 days, your return would have dropped by 3.65% or 3.75%, degraded. You miss the best 20, you're only at 3.62. Miss the best 30, you're down to 1.49. And get this, if you miss the best 40 days, you're now negative. The key to this, however, and this is where I think we are with some clients right now, is to say, well, why, if it's so viscerally bad right now, why don't we just wait and sit and wait? This is the key. 6 of the 10 best days all occur within 2 weeks of the 10 worst days. So the worst days and the best days tend to come pretty close to each other. And that is very difficult to wrap one's head around because before you know it, the opportunity is gone. And let me just give you a great example of where you see this even today. You're going to be shocked. So on the next slide, you can see what I'm talking about. This is 5 days of market activity. So This is March 18th through March 23rd, through yesterday. The market, the S&P over that time frame was down 7%. The most beaten up parts of the market right now, airlines, hospitality, restaurants, pipelines, have all bottomed during this time frame and now are starting to rise. Now, will that continue to persist? I don't know. Maybe, maybe not. But this is what I'm saying is that, like, even if the S&P hasn't bottomed, there are different parts of the market that are not moving in unison with the S&P because they're already looking to the future. So this is, I think, what we all need to keep in mind about just selling and going to cash. Well, you really expose yourself to the second part of that equation, which is the buy decision, and potentially getting that wrong. So that's why we don't tend to do that at all. We recommend being fully invested. So now we've talked about, how we're currently positioned, still fairly defensive, rebalancing, looking to add to select parts that we haven't in a long time. What's the longer term outlook for the portfolio or for the markets look like? And I would say, again, valuation is a poor timing metric, but if you find enough of confirming data points or metrics that look to be lining up, then maybe that's a good opportunity to start getting more interested. So what you see on the screen right now is what they call the equity risk premium. And basically it's the earnings yield of the S&P minus the 10-year bond yield. And so basically it's saying, okay, relative to what you're earning in stocks versus the 10-year bond, that difference should give you a rough indicator of where valuations are. And from an earnings yield standpoint, you can see that we're almost at all-time high levels in the earnings yield, which makes stocks so much more attractive right now than fixed income. And I would certainly say that's an important feature of why we think stocks can either stabilize here or move higher over the next 6 to 9 months, because even the dividend yield on the S&P right now, I'm just talking about the S&P, is at 2%. That's with the ability to grow over time. The 10-year bond yield is at 88 basis points. So you're getting a higher yield that has the ability to grow plus capital appreciation, whereas in the best case with bonds right now, on the 10-year bond yield, you're at 88 basis points. Now, again, I did mention there are opportunities in investment grade bonds that are very attractive, but still, I use this as a reference point to say, okay, well, how attractive are stocks relative to bonds? This is just one metric to look at. From a stock standpoint, you can see what on the screen in front of you is the forward PE or price to earnings ratio of the S&P. And this goes back over the last 10 years. And you can see where it's been. So from using just, I use this metric because a lot of people are familiar with it. There are plenty of other metrics that look just like this, but this is just probably the most recognizable. So the S&P forward-looking earnings picture, based on estimates that came out just the last few days, is now trading at a 14 times forward earnings. Right before the crisis, it was trading at 19, one of the highest levels of the last 10 years. We've done a lot of damage to the PE ratio, which is making stocks fall into a buy range, or at least a relative attractiveness range, especially when you consider the historical average for the PE ratio has been around 15. Now, this is during European financial crisis times, and I understand why this is down here. So you might say, well, what about down here? Sure, I'd take that as maybe a discounting to this 14, but regardless, stocks on a relative basis right now have looked pretty cheap relative to where they've been recently. Next slide I wanted to touch on was, this is an interesting chart because this is aggregate data pulled from the Federal Reserve. The Federal Reserve basically allocates the average investor allocation to equities. Now, how they get to this average equity allocation, I'm not exactly sure, but I think it's in the flow of funds data, if I'm not mistaken. And what this says is, based on investor equity allocation on the left-hand side, what is the forward-looking experience and return tell you? What's been the forward-looking return once we've hit these various levels of equity allocation? So, for example, in 2000, right here, when the average investor had 50% allocated to equities, their forward 10-year experienced return was roughly -5. Contrast that with 2009, March of 2009, when the average equity allocation was roughly 28 or 29%. The forward-looking experienced return from someone that started on that was roughly 14%. And what is this reference point telling us right now? Well, average investors around 37% equity allocation. The 10-year experience from here is somewhere between 6 and 7% on average. Now, again, that can be enhanced with things like active strategies or other ways, but this is just the average expected return. So we feel pretty good about how this is lining up with future returns from this point. I was mentioning international stocks haven't looked cheaper in a long time. What you see here is what they call the Shiller PE ratio. The Shiller PE ratio is basically takes the last 10 years earnings and averages them out and puts them into a PE ratio. You can see the US on a Shiller PE ratio came into this crisis in the low 30s, emerging markets and developed markets in the mid to high teens. But look at what's happened to both emerging markets and developed markets, Europe and the like. They're now trading at valuation levels they haven't been at for probably close to the last 40 years. So that's a pretty, I think, good signal that looking at international again is starting to make a lot of sense. And then finally, I don't want to keep you on the line too long, so I do appreciate your patience and your time. I'm trying to get to all the questions through some of these slides. After we have a 25% drawdown, what's been the 1-year, 3-year, 5-year, and 10-year return after that has occurred? So in December of 1961, there was a drawdown of 25%. And this just tells you what the return experience was over all these other time periods. So I guess my point in bringing this chart up is that, and as I mentioned in other market presentations, is that time is your friend. The more time we can give to our equity exposure after some of these big drawdowns occur, the better our return experience can get. So maybe this is a 1987 type case where we get a sharp snapback. I'm not saying that's our base case, but maybe it is. The 10-year forward return from 87 to 97 was over 300%. Similar in the early 80s. Then, of course, in September of 08, what was that particular outcome? So I guess the net of this slide is that time is your friend with the equity markets. And then these are some of the opportunities. I'll just briefly touch on these because I know we're running short on time. This is the pipeline sector. I just wanted to touch on this real quickly, just to give you an idea of the scope of what we're talking about here. We actually exited this position back in late 2014, early 2015. You can see the drawdown that occurred after that, roughly 60%. The yield at the 2016 low was 12%. Today, you can see that prices have fallen through March 23rd, through yesterday. Prices have fallen 65% from their recent high. And even if you cut the dividend by 25% from the current rate, what do you get? You get a 17% yield. That's pretty compelling from a risk return standpoint. Even though energy is a sector everyone loves to hate right now, there's a lot of stress that would really have to occur from here for us to even get to this dividend situation. So that's one opportunity that we're looking at. High yield bonds I mentioned. You can see what's happened peak to trough in the financial crisis. We got down to 33% losses in high yield in the mid 2015s, and energy, when energy went from 120 to 30, energy bonds high yield bonds went down 13. Today they're down 22%, presenting us with a pretty interesting risk return setup because we don't think this is a great financial crisis type situation. And then finally, maybe that's gone under the radar for a lot of people has been real estate investment trusts or REITs. There's been a lot of anxiety right now in the markets to suggest that people aren't going to be going back to work anytime soon. Therefore, offices are going to remain vacant and going to be creating problems that these REITs won't be able to overcome until some recovery happens. So REITs have now, from their peak to trough, have fallen a staggering 43% over the last few weeks. We think that's a bit overdone. We haven't made any allocations to REITs, but just something that we're looking at because the carnage in REITs has been really visceral, and it's now starting to get to levels that we find attractive again. We haven't owned REITs for probably 4 years now. So I think we exited in 2015 or so, but now we're starting to get back to levels that are making sense again. And then finally, I did want to touch on elections and politics because I know that's been a lot on the minds of people, especially from the question queue. So this is a website that I would definitely encourage you guys to take a look at. It's what they call a prediction market. And it's since legalized gambling became, gambling became legalized, you can now place bets on who's going to win the election and who's going to, all kinds of varieties. But these are really interesting because it's not what pundits are saying. It's where actually people are placing their money, and no one goes into any bet wanting to lose their money. So this is why I tend to look at these from a prediction standpoint. But what you see here is up until the start of the crisis, President Trump had a pretty dominating lead from front runners Joe Biden and Bernie Sanders. Bernie Sanders was actually much higher. He's since fallen off the map. But what's happened is that as we've gotten further into this, coronavirus crisis, Joe Biden is now looking like to be the presumptive front runner, if you can believe it, from almost a nothing, 3 weeks ago or 4 weeks ago. Interestingly enough, Mike Pence still is on the chart as a possible contender. For some reason, I guess there are some that think that impeachment is still a possibility. But this is just to show you that I think the handicapping of the worst case scenario, as I mentioned in our market outlook in February, was that if it appeared Bernie Sanders was going to be elected, then that would tip the scales in a way that might lead us to be much more conservative around certain sectors of the economy, like healthcare, transportation, and things of that nature. Because he's actually not anywhere on the chart anymore, we've got, in both cases, either Biden or Trump will probably be status quo from an economic standpoint. So we're not necessarily too concerned in either of these outcomes based on policies that are being presented right now. I mean, certainly we have to worry about inflation, but nothing that they're talking about really has a big impact on the economy from what we're looking at so far. So with that, I think that about takes us to the end of our time. I know we've kind of gone over a lot of what questions you all had for what has been pre-submitted. And I would encourage you, we'll stay on the line. If anyone wants to jump off, I really do appreciate you taking the time to spend some time with us today. But if you would like to use the chat function, that'd be great. We can't really open it up because there's a few hundred people on this line. But if you want to use the chat function to ask a question, I can stick around. If you don't have time to stick around, that would be fine for you to exit, and we'll circle up with you at some later point. But I would encourage you to, if you did want to talk to Hank or myself or get our thoughts on the markets at any point, we're here for you. Please connect with your advisor, and your advisor can put some time on my calendar, or we can put some solutions together in writing. In the meantime, everyone, hopefully stay inside, shelter in place as Tony recommended. We're going to get through this and try to enjoy the rest of your day. We'll talk to you soon.